Okay, so we'll move swiftly on to our next plenary in this auditorium, Sustainability Trends, What Investors Want. I'd like to first invite our moderator for this discussion, Vinamra Srivastava, Chief Sustainability and Sustainable Investments Officer, CapitaLand Investment, to join us on stage. And joining him are our distinguished guests, Ada Choi, Head of Research, Asia Pacific, CBRE, Corinne Peng, Regional Head of Equities Research, AIA Investment Management, and Sarah Wimber, Senior Portfolio Manager, Real Estate, APG Asset Management. Ladies and gentlemen, let's give a warm round of applause for our panel. Over to you, Vinamra.
Okay, thank you very much. This is a great example of gender diversity. First with Francisca, now I'm surrounded again by some amazing experts in your respective fields. We assembled this session because we thought between the three of you, you represent different angles of the industry on this topic. Before we get going, I wanted to start with a very short poll. Can we have the poll up, please? We wanted to ask you, how are investors and asset managers viewing sustainability performance in relation to shareholder returns? So essentially, what in your view is more important, if at all you think there is one more important than the others? The QR code is up there. I may probably ask this to all of you as well. You don't need to flash your phone, but let's take a minute and can we have everybody participate on this, please? Still heavier on shareholder returns first. I asked the same question, and on purpose I kept the same question. I asked the same question back 2.5 years back at our investor day. And I think we had almost the same kind of split in the answers on which of the two is more important, if at all there is a comparison to be made. But okay, I think we get the drift. I'm encouraged to see much more inputs on ESG becoming a filter even before you talk about shareholder returns. But I'll be keen to understand that. Sarah, I want to start with you. At APG, you deal with a lot of private investments, and as a portfolio manager, how do you align with your investee companies on the entire decarbonization pathways, given that the minds may not always meet? How do you get that alignment across the geographies?
Thanks very much for the question. And yeah, thanks firstly also for the introduction and for the invitation to be here. So excellent to be seeing so many quality speakers today, and very, very happy to be partnering with CapitaLand on this. CapitaLand are a very important partner of us, and actually, yeah, probably would answer your question in relation to that for aligning with decarbonisation pathways.
Aligning with companies except CapitaLand, yeah.
Maybe, can I just interesting, I want to respond to this one, which I find interesting first, and maybe we'll go on to it when we talk about capital allocation, because for us, I would choose very much the second one, right? And we'll talk about it, I think, in a little bit more detail. But from an APG standpoint, ESG is definitely the filter pre the investment decision. So I find that interesting, actually, and it's good if you are saying that you're tracking it over a few years, that actually that one is on the rise. So at APG, we use a lot of different tools, right, to kind of be assessing the decarbonisation pathway. And I think, we had Yvonne here earlier. So APG was obviously one of the founding 3 members to the GRESB network. And we are now a founding and funding partner of the CREM pathway as well, which is, the Carbon Risk Real Estate Monitor. So that is one of the ways that we aim to encourage our investments from the company level to achieve that Paris-aligned decarbonisation. So, for anyone who's not familiar, that obviously puts forward a pathway through to 2050 to enable then looking at the way in which each individual asset can decarbonize, and it's a pathway which is set out for individual country and then asset type. And for us, then we look at what the physical risk is of that individual asset to aim to ensure that it is not stranded up to the year of 2050. And for us, we aim to then have the whole portfolio mapped and CREM aligned by 2030. So we are very actively working across all of our portfolio companies, funds, both on the private and then on the listed side, to ensure that we're actually staying aligned. It's quite interesting, and I really liked the sharing in terms of the decarbonisation and the carbon credits, because clearly that is a topic which is very very much live to at this moment. We do adopt the SBTi definition of net zero, and so we do work with our partners to see, yes, carbon credit is often used as one of the points of the last resort for us, but clearly I echo actually your comments in regards to that being one of the things that we would consider. And I think, there's been a bit of discussion, and this morning we talked about it too, which is the way in which actually we as, private sector and government sector can come together. So increased collaboration definitely, is something that we would want to do. We see the pathways as an ambition. We, totally recognize that, particularly for some of the pathways in Asia, those aren't perfect, right? But actually over time, then, we're trying to work towards ensuring that actually they are suitable for both the asset class and the geography that they are invested in. So, if we look at today's environment, I was reading, one of the reports out for one of our Australian student companies. They map the living sector for the requirements of that utilisation across Australia, Singapore. Arguably in our hotter climates, those are much more difficult to achieve, because it makes an allowance for cooling and heating, but doesn't necessarily, make that nuance. So I think that's something that we're continuing to work on as well, to ensure that actually, these pathways are suitable for the climates and the asset types that they are tracking.
Very, very scientific. Corinne, at AIA, you are both, again, an asset owner and an asset manager. I was surprised when last time I found out how many buildings AI actually own directly through your own investments. How are you approaching the same thing in terms of engaging your companies?
So we have 237 billion of assets under investment, right? And just a year ago, we had our SBTi targets validated. So you're right, there's a lot of work to do. We have to basically engage our investee companies. Basically, we have 60 analysts on the ground. If you look at our asset base, right, 70% of our assets are in fixed income, and then another 22% in equities, and then the last 10% are in alternatives. So what we have to do, basically, we have 60 analysts spread across the Asia-Pacific region, and we go out there to engage investee companies. Of course, we love companies like CapitaLand is really poster boy for us, because if you look at our overall emissions...
It's not scripted, by the way.
Yeah, it's not scripted. If you look at our overall emissions, right, more than 90% are actually Scope 3 in nature. So they're all sitting in our investment holdings, right? So we can only do so much in trying to improve the efficiency of our buildings and so on. So a lot of time is spent with our investee companies, understanding their transition pathways. We ourselves also put out our very first climate transition plan last year. So there's a lot of learning to do. And because about 60% of our assets are actually in Asia, where, of course, disclosures are variant and so on. And when we looked around at all these third-party data vendors, and you rightly pointed out that all kinds of different standards and data being disclosed. And when you look at IPOs and private debt, there's like very, very little information even from third-party vendors. So in the end, we decided to create our own in-house ESG rating framework where we basically rate our issuers. We have like 34 metrics, and some of them are sector-specific based on SASB, for example, and some other like other different industry standards to basically try to level set and benchmark each of our investee companies against their sector peers, so that we kind of know where everyone is in terms of not just the E part of the transition pathway, but also we also rate them on S metrics, governance metrics.
34.
Yeah, so we have 30. So
do you share that with your investee companies?
No, we don't share that with our investee companies, or they may not talk to us again, just joking. But it's just for our own internal analyst reference. And that ties into your question, right? Because we try to integrate ESG considerations into our investment process. We are long-term holders. I mean, we are long-term shareholders of all these companies. We're not going to, divestment will be like the very, very last resort. So we want to take them along with us in this journey. So we track them, and when we revise our rating every year, we update on a regular basis, and we talk to the companies. Yeah.
As long as I don't get to hear about the 34 means we're probably doing okay. So I'll be glad then. Edda, we talked about scope 3, right? You, through your research at CBRE, get a lot into the mindsets of tenants and customers. I mean, and ultimately, we often forget that the entire business is built on customers being in our buildings, right? What are they prioritizing? And in particular, are you still seeing focus on things like certifications, or they're actually starting to push on actual emission, actual performance? What are some of the trends that you're seeing there on the tenant side?
Well, I think the certification is the basic, right? So I think we are looking at Singapore, for example. The green building certification is already over 90%. The same case for Australia. Hong Kong is catching up, China is catching up. So this is just the basic. And now we are hearing that they will go further in terms of the green leases, how to align between tenants and landlords, and also more specific, for example, some of the tech companies or some of the larger corporations, they want to see whether your portfolios or the assets that you have renewable energy. Of course, I think climate change is also very important, so they are having more details on those requirements. But I think it's very interesting. I think last time when we asked landlords and tenants, how do you count scope 1, 2, 3, right? So for landlords and investors, they are trying a lot on scope 3, and I guess some are also required by the stock exchange. Well, when we ask about the tenants, it's a mixed picture. Some of them are not using it, but many of them are expecting 2030 to achieve this net zero target. And now we are having some question mark about that.
And with all of that, are you seeing any rental premiums or brown discounts as sort of carrot or stick for this?
This is a question that varies from one market to another market. We are so lucky here in Singapore, you've got over 90% already green. So you can expect there is not much change between non-green and green, but we are now doing this study. We are running models on almost every market, over 800 buildings across Asia Pacific. And for those markets that have lower amount of green buildings, we do see this premium. And we are also seeing a bit more premium for the highest rating. So if you've got platinum, so there will be a bit more rental premium. But I think from the tenant side, they keep on telling us they don't want to pay.
Yes, I'm glad my leasing guys are not in this room. Otherwise, I'll tell them, yes, Ada said there's a premium, and they'll say, where? I'm not seeing it in any conversation. Right. Sarah, linked question. How do you guys balance the question of financial returns? I mean, how do you approach it? What are your principles for allocating that green capital? Any example that you can share?
Yeah, thanks. So we, whenever we look at a new investment, be it either to invest in a new company or a new fund, or actually if we've already earmarked capital for that, when some of those would come and judge it, we look at it on a diamond basis, and all of the quadrants are rated to the same proportion, and so that is risk, return, cost, and ESG. And where we look at it, return is clear, right, from an IRR or an equity standpoint. From a risk side, it's interesting, and it perhaps extends a little bit on what Emily had mentioned in terms of GIC's approach earlier. We take it, I would say, a bit of a step forward. So when we look to invest in an individual asset code, yes, we track the geo coordinates of that particular location, and then we run it through a physical climate risk, but we assess it across 4 metrics. So it's the probability of that event happening, the impact of it, but then we actually triangulate it with another data set, which is to look at what the exposure and the vulnerability of that particular asset or location is to that particular physical climate risk, be it flooding or sea level rise, storms, wildfires, dry heat, water stress, whatever it may be. And then that comes up with a scoring mechanism, which is actually overlaid to the discount rate that then we apply to the investment. So that then is already a risk monitor that the individual investment, if it is in need of a particular basis, is accounted for when we look at the element of risk. Then we come on to the cost, and what we overlay on that is thinking about the social side. So, that we require a very high-level minimum standards in regards to, good governance practices, management structures, employee relations, bribery, anti-corruption methodologies, etc. And that is given a soft factor, which comes into our cost-based approach that we look at. And then lastly, we look at the ESG itself. So, really, ESG has one of its own quadrants, but actually is impacted across the other 3 as well. And the ESG side of it, yes, it is, the assumption, obviously, that we do require as a minimum standard all of our companies and assets to report to GRESB, as well as then, potentially whatever the local green building certification is. And then it's about mapping the transitory risk of that in particular asset. And that then goes back to what I spoke about earlier in terms of the CREM pathway. So I would say, for us to even get in the door, it requires that. And then it kind of goes, to some of the discussions we had around, the financial, and I'm not going to kind of get into any kind of acronyms because I know that we've tripled over them all the time, but obviously as a Dutch pension fund, we are regulated by the SFDR. We ourselves are an Article 8 fund, and therefore, we do require our investments at least to be at that level as well from a disclosure standpoint. So it is fundamental to the way in which that we look to allocate capital. And I think, maybe added, to your point, for us, it's about an opportunity, right? Because, you may say, okay, and, maybe there are certain niches where tenants do or aren't willing to pay. But what we want to see is actually how does your next buyer analysis look like, right? Because, ultimately we think that if it isn't something that you're accounting for today, then that's actually something that, your onward buyer is going to account for, and it's going to impact in terms of where your liquidity is for that asset, where your exit is for that asset. So, for us, it's not necessarily do we trip up on a green premium or a brown discount. Actually we just would not invest if it didn't meet that minimum standard, because we think we can opportunistically deploy capital, and that longer term, same thing, for the Tamasex GICs, we are a long-term investor, and therefore, we think that these are the buildings which ultimately are going to outperform, and that is how we manage risk across the portfolio.
Very insightful. And actually, just since you mentioned that point, and I want to check, exit valuation, are you, and maybe that's not enough private transactions that have probably happened over the last 1 to 2 years because of macro, but are you seeing ESG in some way or the other starting to get reflected in exit valuations?
I think the valuation or the exit valuation is still largely depending on your income stream. But I agree with you that what is the exit strategy if you are buying a brown building? and whether you need to consider a refit of the building to upgrade. I think some of the investors talk about this strategy, turning brown to green. Is it a viable strategy? Or you just buy a green building at the first place?
I understand. So Sarah, in your analysis with the pillars that you mentioned, the diamond that you mentioned, let's say a particular investment may not score that well on the ESG side, right? But everything else looks very good. So in those cases, how do you approach it? Does the investment go through, and then after that, sort of what happens?
Yeah, it's interesting. I mean, I guess it would depend. Firstly, if it is an investment which is already within, like if it's an underlying investment already in one of our existing funds, then we would want, because we always require very strong governance typically, right? And I'm speaking across the private side. Obviously, we've got the listed side as well. So we would expect to work with our partner in that regard, and would say, look, okay, we're not going to make this investment unless it hits that requirement. I would say that is when actually we take a lot of time to do the engagement.
So you have those
right?
conversations.
Yeah, we have those conversations for sure. We have. I mean, I'm just pure on the investment, portfolio manager, asset management, but we also have a team, a very strong team in RI, right, that sits to look at engagement. We're very much an active shareholder on the listed side as well. So, we look to have that engagement. We look to have that education. I think it's something that we try and do to bring our portfolio companies along on the journey. And this is something that we've had a lot of conversations with when we say to people, okay, well look, we want you to report to the GRESB. We want to see your disclosure. People have a concern over, okay, but look, does that mean that I'm going to be bottom rated? You're not going to invest? And we say, no, actually, what we track is the degree of improvement and enhancement over time. It's a trajectory in which you're working with. And that is why then, we are tracked. My KPIs are, in part, done on what my engagement has been with my portfolio companies, right? So, we're not expecting to say, oh, look, we expect to see that everybody has the answers today, but actually it's the trajectory and ensuring that you're responding to that engagement, which is something that we're monitoring.
Got it. Just a reminder to all the virtual audience, I'm told there are 150 to 200 virtual audience. Please keep sending in your questions. All of you in the room, please use the QR code that we can build in to start populating the questions list, and we will come to it soon. Corinne, I want to pick off from the point that Sarah mentioned on listed and private, right? When you look at your bottom-up transition opportunities, how do you sort of approach listed investments versus non-listed investments? Is there a different strategy of engaging them, of evaluating them? Can you share us a bit more thought process around that?
Sure. So we have a completely different approach. So for the privates and alternatives, we recognize that we probably do not have that in-house expertise, and therefore what we do is we work with like-minded partners, the external fund managers, and with that we develop another scorecard, right, this time to rate funds, right, and to do annual due diligence as well, to make sure that their objectives are aligned with ours. For the public side, this is where, yes, we really look at individual companies, and we have set very hard targets for ourselves. By end of next year, 31% of all our investee companies that are in scope under SBTI has not just committed but validated SBTI targets for all sectors except power generation. So we literally have to monitor the data and the disclosures and the transition progress of all our in-scope investee companies to make sure that we're on track. And by 2040, 100% of all these companies across all sectors have to have SBTI targets validated. And specifically for power generation companies, by 2030, we have to cut their emissions intensity by 49%. So again, we are monitoring every single power generation holding that we have to make sure that we fully understand where they are in their decarbonization pathway, and we basically engage all of them. Yeah.
And given that this transition pathway could be very varied based on geographies or even asset classes. How do you deal with those sort of ambiguity, or is it more a top-down target across the portfolio, or does each geography needs to go through this? How do you cater for this variance of local conditions, etc.?
Yeah, so this is a group-wide target, you're right. And we recognize that basically we have different AUM exposures in the different geographies. So just roughly speaking, about half are actually in the Asian markets, half are based in the US, European markets. And so for those that are based in the Asian markets, we have analysts on the ground who will really monitor each and every one of them. Previously, for the companies that are held in the US, European markets, they are actually in funds that we have actually farmed out to global debt managers, global equity managers. But what we have found is that ultimately the onus is on ourselves as asset owners to engage them directly. So late last year, basically my own job scope expanded. Even though I've been doing ESG for years at AIA, they added and stewardship into my designation, and I set up a team of 4 stewardship colleagues who have started to engage the companies based in the US and Europe, which we own, because we realized that whilst we have farmed out to external managers, global debt and equity managers, because our requirements are so specific and fairly stringent, it is challenging to ask our external managers to do their engagement. And therefore, we have developed a team in-house for stewardship, where our stewardship team will also engage such companies. So it's aligned with our own in-house credit and equity management strategies. Yeah. And approach.
Very thought through and structured, I would say, and complex therefore as well, right? Ada, what are the differences that you are seeing across the APAC countries in terms of where they are in their maturity journeys? And are you seeing any sub-regions being more advanced than the others, or any interesting trends that you see within APAC that you found surprising? Yeah.
So I think the leaders quite clear is like Australia, Singapore. I think I'm quite surprised that India is catching up very quickly. And I think we also know that China has a lot of the headwinds in their economy. They are also setting their target for net zero later. So the companies and the landlords in mainland China, they are putting a lower priority on ESG and prioritize more on the other things, like getting the rents, getting the tenants. So I think these are the things that we are observing, quite a big difference across the region.
And in terms of sort of data and technologies, which is a critical part of this journey, any interesting trends are you seeing in that front?
So I think you've also shared quite a lot, right? The use of AI and the use of the technology sensors to help us to monitor those energy efficiency. I think this is one of the things. We hear quite a lot. Some of the occupiers want their portfolio to have renewable energy. But I think it's quite a mix. I think you've also mentioned it's quite a mixed performance. We usually hear is a low single-digit consumption being generated by the renewable energy in their portfolios. Or we also got another, I'm not going to name them, but one of the client we work with, they've got a windmill, and it's out of order, and no one knows how to fix it. So these are the things that we hear and there, and it's going to be quite challenging overall for property management.
Okay, I want to jump into some of the questions that are coming in. Social has a broad spectrum. Amongst the social metrics, what are the ones important for the real estate sector? Anyone of you wants to take a go at it? What are the important social metrics that you consider critical for real estate?
Yeah, I can make a start on that one because it's an interesting one. I think actually kind of has some tie up with the third one as well, right? So ESG having equal weighting. So maybe you can touch on them both. Yeah, I think if I look at it, so we at APG have 5 guiding investment beliefs. And we just reviewed them sort of last 6 months. And one of them is societal gain. So what does that really mean, right? That is saying that real estate has a tangible long-term impact on real people in real markets in which we invest in. And that is, sitting at one of our kind of 5 key investment beliefs. And so therefore, whenever we are looking at what the impact is of our capital, social is a very important one. And I think probably, it's interesting if you look at that relative weighting, right? We've had a lot more work that's been done in the E to date. And actually, I think it's the S, which is probably going to be looking forward. And one of the ways in which I would extend on that is to say that, so we have a very strong focus on impact. And we follow, the Global Impact Investment Network definition of what does impact mean, right? So that is looking at investments which generate a positive, measurable social and environmental impact, but alongside a financial return, right? This is where it differs from the philanthropy in itself, and that's, following the GINS definition of impact that we look at. And one of the things that we have put in, or ABP, which is our kind of biggest client, we're a mandated manager, has set out is that we want to deploy 30 billion by 2030 within impact. And one of the things which would come out of that is, yes, 10 billion into the climate transition. And I think there's a significant amount of work that we can do within that space itself. But one of the aspects is also looking at social. So social infrastructure is a very key part of that. And whenever we assess, what that investment is, it's looking at, what is its intentionality. So that's an intentionality in order to achieve a sustainable development goal. What's the additionality? What's the contribution? And then therefore, what's the risk of us not doing that? And so I would say if, you look at it through, we've had a lot of, years of speaking about ESG. If you look at it through the impact lens, actually, I think it's the social side where there's quite a significant amount of still work and deployment that we can do. And that, to one of the kind of coming up themes, yes, I would agree, biodiversity is one of the key themes, but actually I think if you're looking at the social side of our very real industry, that's probably one which we'd expect to see more deployment in. And one of the key questions of that is looking at affordability metrics, right? So, we're very focused at this moment in time on the living sector. And within the living sector, actually, it's about questioning in terms of, where is our affordable metrics? And that is all the way through the demographic trend, right? From, yes, your student to your affordable essential key worker housing, all the way to your senior care, your senior living strategies as well. So I would expect for us that actually, that's kind of going to be a continuing theme for capital deployment moving forward and kind of responding to both of those two. I think that the social side is one thing that we'll continue to see more focus on.
More impact driven, and in cases where it can become part of your business strategy itself in terms of choice of asset classes. Like Corinne, your side, your 34 indicator, any social indicators there?
Yeah, agree with Sarah. Just want to add 2 more indicators. One would be worker health and safety. To us, I think that's very important. And also human capital training, right? I think we're probably a bit more basic in terms of our social indicators. These are the 2 that we value quite meaningfully. And we try to walk the talk as well. For example, in our company, we actually made it mandatory for all our portfolio managers and analysts to actually be certified for CFA, in ESG investing. Right? I mean, that's just a very small example, but in general, we take human capital and training very seriously, plus worker health and safety.
And any other thing from the market that you're seeing? Any other social indicators?
Well, we did a CSO survey last year, Chief Sustainability Officer with the Green Building Council, and we asked them, the developers or landlords, are you doing anything on the social part on your portfolio? So they are doing a lot on placemaking, facilities for general public, maybe the mother's room, maybe the disabled. But there, I think there is a lack of interest, for example, to diversify the tenant profile, to support more individual brands or companies or social companies. And I think another other thing that we have missed in our formula is what's the participation of our policymaker. Because it will help us a lot if we've got this incentive, maybe putting more social or the benefit community in our portfolio with some GFA concession. I think this will be a very powerful one.
Right. I'm just curious, it's not there on the slide, but do you guys ever face trade-offs when you look at ESG as a bucket and in your matrix where E and S are throwing contradictory result on an analysis? And how do you deal with those conflicts then? Or maybe it's a hypothetical question that doesn't exist, then please ignore the question.
Maybe I can attempt to answer this question. I think for us, because of the way the framework is structured, we actually allocate different weights to E or S or G depending on the sector. So we don't really have one where, okay, E, maybe the benefits of E cancels out the negatives of the S, because, basically how we evaluate a real estate sector will be quite different from the way we evaluate a oil and gas company or a tech company. Yeah, so we attribute different weights to this. And so, and then the way we, basically measure or evaluate the companies will be against their own sector peers. So it doesn't really 100% answer your question, but so far we haven't come across where they directly offset each other.
No, I think that makes sense. Because it's got 3 votes, I will take that, but probably expand the mandate. What is investors' views on greening through SMRs technologies on the nuclear side? But I'll probably also, to give the benefit of doubt, I'll expand it a bit broader in terms of investments into sort of a bit more futuristic technologies that can be very impactful. What trends are you all seeing in your respective universes on that? Either capital allocations or feasibility, etc. Is there any private capital going into these?
Yeah, I mean, I think that, we, maybe I'd take it more generally in terms of kind of technologies, right? Because I think that we are cautiously still reviewing in terms of kind of for the nuclear reactor specifically. But one thing that we have tried, and I was saying this to you earlier, one thing that we have tried to do is to invest in a lot of climate tech, so that actually we're ensuring that our portfolio is able to access the best leading advancements. And one of the things that we've done to that is identified 3 prop tech funds across APAC, Europe and the US. And then we work very carefully with those funds, which are very VC in its nature, right, to then be ensuring that our portfolio companies have access to that emerging technologies and that then that is utilizing within our own portfolios. So I think we're very much aligned to ensuring that actually over time we're equipping our companies to have access to the best technologies in which to solve some of the issues we're facing today. So I would say it's an area of ongoing debate in regards to this one in particular, but actually over time we are heavily investing in technologies through our investee companies to ensure that actually we are using those. So the likes of for example Carbon Cure in terms of kind of that capturing green tech. We spoke a lot about the different kind of approaches, green steels, etc. Right, so that we're using the best degree of tech across our buildings, and then therefore encouraging our portfolio companies also to have that dialogue so that then they're able to access them too.
So it's a virtual circle. Edda, are you seeing investments into the climate VC space by real estate players or investors as well? Because the VC space has been going through tough times over the last year or so. Anything that your research throws up on that?
Oh, I don't look at those VC, but I suspect there will be quite a lot. I think when it comes to technology, I will also get back to what I have just mentioned. Just take into account what the policymaker is doing, what the city infrastructure is doing. Because I have this conversation with another landlord in Hong Kong, and he said no matter how much technology you can put in your your building, but if your grid is brown, there's not much you can do. So we are having a lot of dialogue with like CLP, which is a power company in Hong Kong. What's their pathway, for example, to use hydrogen energy? So these are the things that will have a bigger impact, I think, in the coming future.
Fair point. And I think from our experience, it's also not an either-or question, right? What color the grid is or what's the grid emission factor is not directly in your control. And by the same logic, if you have 100% access to renewables, it doesn't mean that you stop your efforts on energy efficiency. It doesn't give you the license to still make an energy guzzler building, right? So it's sort of, you have to approach both
Yes.
in many ways equally. I found this question interesting on, with the focus on ESG, does it skew your portfolio away from emerging markets? I'm assuming the intent of the question is that because there'll be ESG challenges in emerging markets as against, let's say, Europe, does it make you then get out of emerging markets more and be more focused on those markets? It's probably an extreme way to put this question, but any thoughts on that? Yeah.
I have some conversation, but a conversation with investors, but they are not asking whether it's emerging or not. Okay. It's about different asset type. So for example, data center, it sucks in a lot of energy. So if you want to target this net zero, how are we going to formulate our strategy for data center?
Understood.
Yeah, not for us because the way our PMs are benchmarked relative to the market, right? So they basically say they manage Malaysia portfolio. They are benchmarked against the Malaysian market index. So they try to pick the ESG leaders, right? Or the high quality companies within their space, their investment universe. So same for China, Indonesia, Thailand, Philippines. Yeah.
I understand. Sarah, your side?
Yeah, I think it's an interesting question. So we have a overall portfolio allocation in between emerging and development markets, right? And that's a global split. So we have already, that kind of portfolio construction top down, right? I'd say I'd take it in twofold. Firstly, with an impact hat on. If I just looked at dollar for dollar, where can that strong impact is? Yes, of that 30 billion that I mentioned earlier, right, 10 billion is earmarked for the Netherlands. But actually, if you look at markets in which you can invest in, arguably it's emerging markets, where actually you can get kind of more bang for your buck in that regard. So that perhaps would be positive. But I would say that generally it goes back to my comment in regards to what is the required return, right? So as a pension fund holder, we do have a higher bar for our emerging markets exposure, and that is something that we need to be sensitively pricing in. So it would be one of the factors which builds up when we look at it from a required IRR perspective, and it would be coming into that discount rate review that I mentioned, and therefore, yeah, you could say that ultimately perhaps that creates a higher bar for that outperformance. But actually, from a capital standpoint, we wouldn't say, oh, look, we're not going to allocate to the emerging markets because, we don't think that they provide us with the sustainability credentials, because actually that's where your engagement could come forward and actually deliver, better results. So I'd say probably it's more from a risk capital portfolio construction side, which marks our assessment in terms of the markets, rather than necessarily from an ESG standpoint. And then added to your point in terms of from a sector perspective. So we have broad allocations in our geographies across the three regions, being Asia, Europe, and the Americas. But actually, where we do have more stringent allocations is around sector. And definitely that has been something that, we have assessed on the portfolio basis. When you do look at some of your more carbon heavy, carbon intense sectors, right? The degree to which we want to align the portfolio to those. So that's probably where I guess if we look at it from a total portfolio construction standpoint, where it comes in more explicitly than necessarily looking at it from the market.
Yeah, I think same point that you are making on the asset classes, right?
Yes.
Okay, I need to wrap up. Before I go to the last question, I am intrigued with the tone of the last question, so I will take it. Do you experience any stubborn investees who refuse to embark on the journey? And how do you convert them or don't manage to convert them?
Naughty investment D companies. Yeah, I mean, look, we have very strong engagement, as I say, right, on a quarterly basis with our companies in the minimum in order to do that. And, obviously a lot of that is about lobbying at a shareholder level to ensure, for example, board composition is corrective, that, it follows good standards of governance. Luckily, I would say that, we are incredibly fortunate actually because many of our companies we hold in extremely high caliber. I think we're incredibly fortunate to partner with the quality of companies that we actually do have access to. So I would say that generally, the trend is that people are fairly aligned to, I would say LP requests or shareholder requests when it comes to that. But yeah, I mean, there's one I can think of, not going to name names obviously, but the one I can think of right at this moment in time, it's every quarterly review, we put them on and we rate them. And if we don't think that we can have engagement with it, then it would be put up as a potential divestment target. But that isn't necessarily how we see to get the maximum return. Actually, engagement is something that we prioritize much more.
So essentially, what I'm sensing is first a very high bar at the investment stage itself. So you wouldn't land up in such situations most of the times. Then wherever you do, you hope. Wherever you do, then very strong engagement focus. And I think that's the point that Francisca you were making earlier as well, right? Much more about dialogue than divesting, and that's probably the last resort.
Yeah,
right.
Absolutely.
Yeah. All right, I will wrap up now with one final quick question to each one of you, which is your personal take, given the macroeconomic challenges today, as well as the geopolitical tensions, is that, do you think, going to derail at least the near-term progress that collectively we are making on our respective 2030 targets? Maybe why don't I start with Ada first to you, then I'll go this way.
2030 target.
Yeah, but are all these challenges going to mess up with my next 2 to 3 years investments, focus, etc.?
So that's for landlords or for tenants?
Capital in general.
Capital in general.
Yeah.
As I started this conversation, we do have a lot of tenant companies that set their target by 2030, and we look at what they are having now, and we start to question whether it's going to be derailed. For landlords and investors, many of them are setting 2050. Is it CapitaLand also?
Yeah, that's net zero. I didn't ask 2050 because it's just so far away. I don't think my question will have any relevance. That's why I thought let's focus more on the near term.
Okay, so for landlords and investors, many of them are 2050, and 70% respond to our research and saying that, yes, I'm on track. So, but
that's why we don't show our measurement against 2050 because it's just 25 years. It's just too far out to predict. Yeah.
So I guess for them it's not derail. But back to your point about the macroeconomic environment, I think it's depending on which markets. So I've mentioned about China, and the people are now prioritizing the profit, the revenue over ESG. But in Hong Kong, because the vacancy is so high, I think equivalent to 7 vacant IFC at this moment. So every landlord want to invest in ESG, adding one and another certification so as to get the tenants to buy in their portfolios.
Got it. Thank you. Corinne?
I don't believe so. I think the regulations are helping to push the industry forward. And if I think back like 5 years ago versus now, we have companies who are a lot more engaged today. I think we have more reverse engagements. Actually, companies reaching out to us instead of us reaching out to companies, and a lot more data. So I think the trend is we're not looking back anymore. So I'm more hopeful.
Excellent.
Yeah.
Sarah?
I would say it's a risk for sure. If you look at potentially, more decoupling over time, right, and the way in which potentially we're going. But I would say that actually, longer term, we're obviously a generational investor, right? So we take a much more longer term lens, and I think that you can look through that for that basis, and therefore, look at to which the trend is going. And for us, we still stand by in the long-term direction of travel, rather than necessarily looking at it in the short-term kind of noise, which may be there. But I think it is definitely something that we're very, very focused on, because clearly you are starting to see at a higher level, right? Some more breakdown in terms of ties, but we would hope to just look at it in terms of the longer term basis, and still be aligned.
It's super consistent. The themes of longer term focus, there'll be short term upheavals, but focus on the fundamentals, keep moving, in your words, sort of keep hunkering down. So I think there's consistency, and I think for companies like us who are also GPs of funds, managing LP capital, but also operating our assets, that's exactly the path that we want to take to continue to focus on the ground. So thank you very much. This has been very, very insightful. I learned a lot, especially in terms of how scientific all your processes are to evaluate and measure your ESG performance of your company. So thank you very much for taking out the time. Can we have a round of applause, please, for all of them? Very, very appreciative of you. Thank you. Thank you so much.